You've probably heard the old property versus new property debate 1,000 times. Some will say that a new property is better for tax benefits. Others will tell you to stick with established properties if you want to see real growth. And I want to tell you right now that this entire debate is stupid. It's like arguing over whether a Ferrari or a Land Cruiser is better without asking what terrain it will be driving on or what the real purpose of purchase is. The badge or style doesn't determine if it's the right car, and age of the property doesn't determine if it's a good investment. The debate is also hinged on the assumption that all new properties are the same and all old properties are the same. That's insane. A new apartment in an oversupplied area is completely different from a new house in a growth corridor. An established home in Turok is nothing like an established unit in a declining mining town. Yet, people are out there making decisions based on this surface level thinking. They're choosing investments based on whether the paint is fresh or floorboards are original, instead of looking at what actually drives returns. I'm Ankur Gautam, Head of Research and co-founder at Heaps Good Homes. With 300 plus property transactions across new builds and established homes, I combine hands-on experience with a data science background, having worked at Big Four banks, bringing in a data-driven approach to every deal I do. And I want to tell you right now that this whole new versus old argument is distraction. It's stopping you from focusing on what really matters in property investing. So in this video, I'm going to share what you should be focusing on instead. I'll start off by saying that it's not choosing between new and established property isn't important, but there are many other factors that come into play when it comes to getting a good return on your property investment. The real question isn't new or old. It's about you, your situation, your goals, and your financial position. Think about it. Just like a business needs to know if it's turning a profit or losing money, you need to assess if the property deal is going to help you achieve your financial goals, considering all the factors like cash flow, growth potential, risk, and your ability to scale. You need to understand how much income you have, how much it costs you to live, and whether you're coming out ahead or behind. Then you need to see how your property investment decision fits into the bigger picture of your financial life. This is what I call your personal P&L, your personal profit and loss statement. I want you to think of property investing like running a business. You don't make decisions based on emotions, trends. You make them based on data, strategy, and outcomes. And so every deal, whether it's new build or an established property, should fit your personal P&L. Now, while I'm saying you need to ignore the generalized debate about which is better investment, you still have to pick one to invest in. But instead of picking one over the other because someone told you at a dinner that the other is better investment, you need to look at why you're considering in the first place. So let's weigh up when a new property might be the right choice and when an established property is better fit for your strategy. I'll start by walking you through when a new property makes more sense. Basically, if you're a high income earner with aggressive growth goals and aggressive cash flow goals, new properties could be a great fit for three main reasons. First, higher cash flow. New builds, especially co-living or dual key properties, can give you higher rental income from the start, from just day one. I'll give you an example. Say you're looking to invest in Geelong, Victoria. An established 4-bedroom house might cost you $700K. Compare that to a brand new co-living property in the same suburb, can be around $750K. Yes, that's a $50,000 difference, but that extra $50,000 could mean significantly higher income if the co-living setup performs as intended. For investors who are comfortable with new builds and open to stepping outside the traditional model, the potential upside is clear. And for high-income earners, the risk profile is often manageable. Over the next 15 to 20 years, an established home might take a long time before becoming positively geared. A co-living property, by contrast, can be positive cash flow from day one. After 15 years, the rental income difference is substantial, with co-living property far ahead. The cumulative gap in returns over that period can be in hundreds of thousands of dollars. In this scenario, choosing the established property simply leaves too much on the table. For investors looking to build wealth fast, that extra cash flow helps accelerate your strategy. More cash flow means you can reinvest into more properties and grow your portfolio quicker. Second, there is depreciation. For high-income earners, depreciation can be game changer at tax time. For example, let's say you're earning $200K a year and you invest in a co-living property. In the first year alone, you could claim around $20,000 in depreciation. At a marginal tax rate of 45%, that could make you an extra $9,000 in cash from ATO refunds. This is purely from depreciation alone, before even considering your rental income. And the third reason is low maintenance and warranties. Another big win for new builds, especially if you're a busy professional, is the low maintenance side of things. Everything is brand new, so you're covered by builder warranties for the first few years. This means you won't be dealing with things like leaky roofs or broken hot water systems. You're not tied up with repairs, so you can focus on scaling your portfolio instead of constantly fixing things. Because ultimately, your primary career is your profession, not property maintenance. Now, let's walk you through a few scenarios when buying an established property might make more sense for your circumstances. First, you're just starting out and you have a very modest budget. Established property would work well for you here because of the lower upfront cost and the simplicity of the transaction. You can see the house and it can be tenanted immediately, which means rental income from day one. The second would be if you're focusing purely on capital growth and you're not chasing high cash flow. Established properties shine here because we have rich historical data, clear suburb trends, and a comparable sales to help forecast short to medium term growth more accurately. If your strategy is to build equity fast, refinance, and repeat, this could be a smart path to accelerate portfolio growth without the risk. The third reason would be if you wanted to add value with renovations and subdivisions. For active investors who love the idea of value adding, established properties are ideal. With an established home, you have the ability to renovate, subdivide, or build an additional dwelling to unlock more value. And the last scenario would be if you are someone who doesn't necessarily have a very big risk appetite and would prefer more certainty. Established properties have been around for years, so you can look at historical data and make decisions based on proven trends. For example, you can see how a suburb has grown over the last 10 to 20 years. Supply and demand data is much more cleaner and accurate in established suburbs, and we can predict with some level of certainty what the market will do in the future. New properties, especially in emerging areas, don't have that historical context, and some unknowns in supply and demand statistics can make it harder to predict the short to medium term performance. So these are the main reasons why established could make more sense. Also, I'll share a more specific example, a couple that came to me ready to buy a brand new property, but I suggested an established home instead. This lady was a school teacher and her husband was a nurse. They wanted to buy an SMSF with a modest $700K budget. Now, developments are not possible in SMSF. You can only buy off-the-plan projects sold as single contract property. And it makes no sense to do that in a high interest rate and high inflation environment because the builder had to add their holding cost and the risk buffers into the price. So I suggested acquiring an established property in Southeast Queensland with a clear pathway to neutrally gear the property and exit closer to their retirement and switch to a high cash flow property then. With that in mind, let me give you a framework you can use when making a decision about whether to buy old or new. Ask yourself these 4 questions. 1. What is your passive income goal and retirement age? A good rule of thumb is 70% of your current income, and inflation adjusts that all the way to retirement. The ultimate reason why you invest is to reach there. And you need to make a decision that will help you get there faster. And that's how we make our clients visualize the goals and how each decision will change the trajectory with this tech-enabled tool we use at Heaps Good Homes. The second question is, what's your investment horizon? Are you a long-term investor or short-term investor? This shapes your strategy. Next, ask yourself, what is your risk profile? Are you okay with a bit of risk where you might face some short-term pain for long-term gain? Or do you need something very stable? And lastly, what's your current financial situation? Is your budget modest or you have a big enough budget to take bold moves? Ultimately, you need to balance growth, yield, maintenance, and your goals. It's not as simple as new is bad or old is better, and anyone who tells you otherwise is selling you something. Here's my advice. Don't just go for new or old property because someone told you to do that. Do your research, understand your goals, and work out what property aligns with your situation. Thanks for watching. I'll see you in the next video.